How are you doing today? I hope you're having a wonderful Sunday, July 12th. Man, hard to believe, huh? Summer's already here. So as we roll into, the beginning of Q2 earnings, which are universally expected to be bad, if not terrible, I am struck by the belief that we are at least entering, if not in the middle of what I will call an asset bubble. Laid pain and consequences of past decisions, whether that be companies buying back stock, whether that be retailers, adding debt and things of that nature. There were bad decisions, bad business decisions that were made where a normal recession would have caused a repricing. And what we have done in this hopefully once in a lifetime event is we've delayed pain. And this, I've believed this for a while. It just hasn't felt right. But that conversation with Brian Lebo Friday, I think, whenever that was, about what's going on in Vegas real estate really pushed me to look at this. So I spent some time yesterday and today looking at the 1929 market crash. Lots of things to kind of look at there. Lots of, things were put in place so we couldn't repeat that. But again, I'm not interested in the system changes that we put in place. I'm interested in what was going on with consumers. That's all I care about, right? Consumers and cost of capital. That's what this channel is about. And most of the time it's the consumer because cost of capital is going to be really low for a while. So what I was thinking about is so first off, the bubble talk, I think there will be more and more bubble talk. Not only, I think it starts with stocks. I think there is going to be a lot of that when we look at Q2 earnings, and we probably see companies not talk about Q3. So everybody expects Q2 to be bad. I think I talked about it yesterday. S&P down 42 or 44%, something like that. I think people have a rosy picture of Q3. Q3 is going to be worse than people expect. It will still be better than Q2, so you'll see those headlines. But I don't think Q3 is going to be anything to write home about. You know, this health event ain't over. It's going to sap our economy more. It's going to cause consumers to retreat. And I think there's more pain ahead. So I did some reading, found an article that talked about it with Buffett, Cuban, and a gentleman named Howard Marks. I just kind of was reading it. These are things I took away. There's been a lot of flack Buffett has got, probably rightly so, right? Sold airlines at the bottom. I do not think he deserves I don't know what else to say, the ass kicking he's getting from that day trader Dave Portnoy, whatever his name is, the green hammer of death, and stocks only go up. Man, he's going to get his one day, I think. So, we're talking about Buffett, and do you think he's lost his nerve? No, I don't think he's lost his nerve at all. I think he's always been a patient investor, and he's been clear when he thinks the market or the day traders or the speculators or whatever, he just sits on the sideline and waits. Buffett's the ultimate patient investor, and I think pointing at his age is disrespectful and frankly arrogant. I would hope he has his 30 or 40-year track record, that we would at least give him a chance to see what happens. He doesn't chase or speculate. That's very true. Buffett has never done that, near as I can tell. Day traders bet on the greater fool's theory, and that is what is happening now. We have a whole collection of new investors on Robinhood and other like apps who are buying stocks of throwaway companies like Hertz, hoping that someone else will pay more, right? The greater fool theory. That's not where Buffett plays, right? He is always looking at really stocks to him are ownership percentages in companies and future cash flow. He doesn't play in, in stocks like a lot of the day traders do. So that is interesting. And when people start quoting day traders as geniuses, that's like betting on a hot craps player in the casino, right? It happens. People get on runs. Usually doesn't end well. And then to say that the market only goes up, that's that's just wrong. I mean, that's just wrong, right? Yes, you have been right. The Fed, the don't bet against the Fed trade, is been awesome. It is the Nasdaq is at an all time record or near an all time record. I don't remember Friday's close, but yeah, it's worked. Congratulations. But if you stay at the casino long enough, the casino will get theirs. And that's what I remember from my pain from the .com days is I stayed at the casino too long, meaning the stock market, and it got theirs and it came back. Um, so that's interesting. So Mark Cuban, no, actually, yeah, no appreciation for the magnitude of destruction. Mark Cuban's idea is people that are trading in the stock market today do not appreciate the length of the consumer impact, right? The change of behavior, the exodus from cities, the fact that consumer behavior is likely going to change in this event, which it didn't in the financial crisis, it didn't in the .com crash, but it will be impacted. When you have structural changes, that takes time, and the impacts are often subtle, but with great magnitude once they are appreciated. And then there was Howard Marks. I don't know who that is. I haven't heard him, but he was quoted in the article, so I got some data. People are buying stocks for the fun of it. That's not a great reason to buy stocks. And again, I say that as someone who was thoroughly entertained buying stocks. I remember one day in particular, we took a family vacation to Kauai, and we got up early. We traded some Cisco Systems shares, went to have breakfast, came back, and made 30 grand. I remember days like that. You don't trade. That's not a long-term winning strategy. The market will eventually come and get there. So the fear of missing out, which is just the momentum is building, that will pop at some point. But it's probably months down the road, right? We're in July, right? You probably won't appreciate how bad Q3 will be until September. So, it could certainly be crazy for longer, right? Irrational exuberance from Greenspan. I think the market was up 2 years after that statement. So then what I did is I went back and looked at the 1929 crash. And again, I didn't look at it for the structural things, margin accounts and percentage drops, things that the system we have changed or tweaked so it couldn't happen. But what I was looking for is the consumer. So if you don't know this, the 1929 market crash came on the back of what is often called the Roaring Twenties. It was a period post World War One, where rural, I can't say that word very well, people were moving to the cities in droves. And the cities were the epicenter, and the Roaring Twenties were off and running. What is often credited is some of the pin that popped the bubble. There was apparently some agricultural overproduction, which hurt farmers, is often quoted. I don't see that today. In fact, I think we have, actually, we do have overproduction because restaurants are changed, so it's a little bit different. But I see, that's actually interesting. I didn't see that when I took this notes down. Farmers are feeling the pain. That's interesting. Yeah, farmers are feeling the pain because the demand from restaurants aren't there, and you and I have both seen stories about farmers tilling the soil and throwing away potatoes and all of those things. So We have pain. Well, actually, it's interesting. We have pain for the farmers. We saw signs of steel production, construction, auto sales, and consumers were building debt. I think those are all going to be okay. I think we don't produce a lot of steel. I think we will be increasingly doing more steel. I see an infrastructure bill ahead of us. I actually think construction goes up from here from down because we haven't built enough, right? We have a historical lag, so construction should be fine. Auto sales are down. That'll be interesting to watch. I think there is a general, I think auto sales short term are going to be okay, but are they down long term? Don't know. And then consumers are actually not building debt today, they're paying off debt, right? Revolving credit is down. So, yes, it is interesting. Um, so, it's interesting. Uh, and then just to appreciate kind of the depths of the crash, one of the things to point out is again a prick of the balloon was the London crash. I didn't actually know this until I read it this morning. Apparently, London, England, their market crashed first, and huge margin calls and the like, which could have been cause for what happened in New York. But it sapped the U.S. optimism, which led to back-to-back days of October 28th down 12.82%, followed by October 29th down 11.73%. And just because dead cat bounces are real, October 30th was actually an up day. It was up 12.34%. Just thought I'd throw that in there. But from there, stocks continued down for the next couple of years, ultimately losing 89%. Is that right? 89%? Yeah, 89% of their value peak to trough. So that is sobering. To be clear, I'm not calling for any kind of 80% loss peak to trough, but going down 40 or 50% is certainly possible. I don't think we are appreciating the length and the impact of this. To see what's going on in Arizona, Texas, Florida, California, which by some accounts I think are 33% of consumption, right? And we're a consumer-based economy. It is, I think we have more pain ahead. And I don't think it's appreciated. And frankly, I don't think it will be appreciated for weeks, if not months. But I wanted to have this conversation. It's a Sunday. It's a slow news day. You should ask yourself these questions. Yeah. And just to close on a high note, there haven't been a lot of live concerts going on, but I thought something interesting happened with Brad Paisley. He is a country singer. I think I saw one of his concerts 5 or 6 years ago. Well, he just held a drive-in concert. I thought that was pretty creative, right? Drive-in movies are becoming more popular because of social distancing. Brad Paisley put on a full show, lights and all, real stage in a drive-in in Nashville, Tennessee. So it'd be interesting to see if those take off if this goes on. So live sports, concerts, let's get back to being what makes America fun, and maybe we'll stop day trading stocks during the day. So that's what I got. I am going to do another live here in a few minutes with a reaction to Gary Schilling's interview on CNBC. Gary Schilling did a good interview on what he thought the economy was doing and why he thought stocks could go down. 2 or 3 of the viewers of this channel sent me the link, so I owe you my reaction. And I watched it a couple of times this morning and got my reaction. So I'll do that in a little bit. All right, everybody, take care.